Welcome to ETF Leaders, powered by the New York Stock Exchange. I'm Judy Shaw. Joining me today is Sean O'Hara. He's the president of Pacer ETF Distributors. Sean, thanks for joining me.
Thank you for having me.
So let's talk about 2019. It was a big year of growth for Pacer ETFs. Tell me about some of your achievements and what makes Pacer so unique.
Well, thanks for asking that question. Of course, it lets us tell a little bit about ourselves. So we grew by about 75% last year. We started 2019 with about 3.2 billion in assets, ended with about 5.6. So we had a pretty nice year of growth. I think we achieved that growth mostly by doing the things that we had done to lead up to that. Our Pacer Trend Pilot series continued to be attractive. We added to the Cash Cow series. We had a couple of nice returns out of some of the real estate ETFs that we launched. And then we partnered with CFRA to do a seasonal rotation strategy. And sort of all of that added up to us extending our product lineup. And what we focus most on at Pacer is we focus on the financial advisor and trying to help them grow their business and then create ETF solutions that fit the needs of their customers.
So you mentioned Trend Pilot and Cash Cow series. Why did you add those?
Well, we added, most importantly this year for 2019, late in the year, fixed income for the first time. So all of the Trend Pilots had been equity. Like you could get the S&P 500 in a Trend Pilot format or the Qs in a Trend Pilot format. We added a fixed income version of Trend Pilot that uses a high yield index over a treasury index. And the whole idea there was we've gotten to where we've gotten to as far as AUM without any fixed income solutions. And so we needed to move in that direction. And then even bigger than that, the average person who's looking at fixed income today is really starving for yield. So a high yield Trend Pilot gives them the yield that high yield provides with a little bit of risk management because of the Trend Pilot mechanism.
Now 5G, that's been a hot topic.
Very big deal for us. Last year we have an ETF, SRVR, which focuses on the data centers and the cell phone tower companies. If we're going to have a build out in 5G, Internet of Things, streaming, e-commerce, all those things eat up massive amounts of computing power, and they need the cell phone tower companies to get the networks right so the information can flow correctly. And so we're supplying the critical infrastructure in the form of publicly traded real estate that will fulfill those needs for those technologies to continue to grow.
Now you also partnered with CFRA and also Sam Stovall on an ETF. Tell me about that.
We love Sam Stovall. He's an industry icon. One of his rules was sell in May and go away, which everybody knows about. They developed an index that essentially uses that as the framework. We don't sell in May and go away. What we do is we rotate sectors of the S&P seasonally, because there is a seasonality to the return of the market. So we own defensive sectors from the May to October timeframe, and then from November to April we own the cyclical sectors. And that again works great in an ETF because of the tax efficiency of ETFs.
All right, and you acquired the American Energy Independence ETF at the end of last year. What opportunities do you see in midstream energy?
Well, we didn't have an energy story, so that sort of fit the bill. We like Simon Lack, who actually launched the fund initially, so being able to work with him was a big deal. But when you think about midstream, all the infrastructure's been built. So there's been a lot of CapEx building out the pipelines in the distribution networks that's going to carry the energy in the U.S. And as we move closer and closer to energy independence and produce more and more energy, the revenues we think will go up based on how much product is flowing through that network. But the real opportunity we think there is that the capital expenditure from those midstream names is going to slow down. So they're going to see an added increase in free cash flow as they reduce their CapEx. So we think it's a good long-term investment story, and it fits the yield category for us as well because it's a very, very attractive dividend yield.
Sean, thanks so much for joining me here at Inside ETFs.
Thanks for having me, I appreciate it.
And that's ETFs powered by the New York Stock Exchange.